All right, what is up, Patriots? What is up? Happy Monday, everyone. Hey, welcome. Hey, this is a brand new weekly series that we are kicking off for the first time tonight. So if you guys are here watching, you get to see the pilot episode, the brand new Military Money Mondays. And basically, what we're going to do every week, I know we're starting a little bit later this week, but we're going to be starting at 5 o'clock in the future going forward on Mondays. And we're going to be diving into a specific topic every single week that is going to focus on how do we maximize veteran benefits? How do we build tax-free income? How do we build lasting legacies of wealth for those who serve and protect our great nation? If you're new here, my name is Dan Farnsworth. I am a retired Navy officer. I served 23 years active duty. And now in retirement, as a licensed financial professional, my mission is to help veterans build wealth. And we want to do that in ways that keep our money out of the government's hands and back into our own banking systems. And so that's what we're going to get into tonight and what we're going to get into week after week. Because we want to continue to expound on these principles. And our mission is to educate and teach as many veterans as possible how to take advantage of these extremely powerful wealth strategies. So, what is our topic for tonight? Well, we're going to be looking at a basic scenario involving military retirement, okay? And how can you build your own pension as a service member, even if you didn't serve 20 years in the Navy or in the military, right? I keep saying Navy, but if you didn't serve 20 years in the military, how can you still build a pension that is going to last for the rest of your life and be comparable to one you would have earned if you had served over 20 years? And if you did serve over 20 years, great, awesome. So you're already receiving a pension. So this is basically how you could build a second pension to essentially accompany the one that you're already receiving, except this one's going to come with some caveats. And the number one being it's going to be tax-free, right? So not even a military pension is considered tax-free. Unfortunately, we still tax the Joes the same way we do the rest of the general public. But this pension that you're going to build yourself is going to be tax-free. All right, so let's go ahead and get into some of the facts. So we'll kind of set the stage here tonight talking about the overhaul of the military's retirement system that took place in 2018. Okay, what happened in 2018? Well, the traditional or historical, I guess you could say, High 3 redux system was replaced. Now, we can argue all day long about the reasons why it should or shouldn't have been, but the fact is, it was replaced by the blended retirement system, or BRS, okay? Now, under the current, right, because it still technically exists, but under the current system, which has existed for several decades, many decades, in fact, when you retire from the military after serving a minimum of 20 years, you basically have a pension that's going to be given to you starting immediately, and that's going to remain for the rest of your life. It's going to continue. You're going to get your monthly distributions. It's called an annuitization, okay? And that's going to be for the rest of your life. Well, those days are pretty quickly coming to a close, okay? Because anybody that came into the military after 2018, after January of 2018, is now automatically enrolled under the BRS system, right? Which means that there's going to be an income gap from the time, if they do retire, there's going to be an income gap up until the age of roughly 55 to 60, and it really depends on how many years you serve. But suffice to say, 60 is a good benchmark. That's when you're going to be able to draw your pension, very much like those in the federal civilian workforce who have been under the FERS system for quite some time now. Same concept, right? Drawing it at age 60. Also reservist, by the way. Now, the BRS system does have some positive caveats, right? In that it also includes a 1% automatic government TSP contribution plus up to 5% match, depending on how much you want to put in. Now, we'll kind of get into some of the ins and outs of that, maybe in a different topic. We're going to talk a little bit more about that here tonight. But that 1% automatic contribution is going to become a factor going forward in our strategy. And we're going to sort of show how we can incorporate that even if you don't serve a full 20 years of active duty. All right, so essentially what this change means, well, the new system places more responsibility on individual service members, right, to create their own financial security plans. Because again, you're going to have an income gap of somewhere between 10 and 20 years. Even if you retire after 20 years, okay, you're still going to have that income gap where you're not going to be receiving that pension until your age roughly 60. Okay, again, it could be adjusted by a few years, but we'll say age 60 is when that actual monthly pension is going to start, right? So in that time, we want to kind of figure out what is the best way to kind of supplement the income and to also be, stuffing money away, right? Saving money, growing our savings, accelerating growth on our savings to be able to, one, obviously create a nest egg that we can live on later, but two, minimize market exposure, because that is the one thing that TSP cannot guarantee, right? TSP has some great features, right? It's got low fees. It has historically pretty good performance, but it cannot limit market exposure because your money is invested directly in the market. And the other thing that TSP cannot do is it cannot yield money tax-free, right? And that's what we're going to focus on here tonight, is how do we build essentially a pension that is tax-free, that you're going to be able to draw on for life, that is going to have zero market exposure. So when if the markets tank, which invariably they do every, 20, 30 years or so, maybe less. I mean, we saw some pretty tumultuous years from, during the Great Recession era. 2008, we saw a 40-point dip in the market. We saw another 20 to 30-point dip in the market in 2022. Okay, but we're going to build a plan that's going to be immune to all of that. And this is how we're going to do it. Okay, so we'll talk about some of the additional pros that exist with the BRS system. So you do have a lump sum option available at 20 years. That'll probably be a topic for another weekly discussion. We'll kind of dive in on how we can take advantage of that. Suffice to say, even in the Redux system right now, there are significant advantages using privatized options. If you were to take the Redux option at the 15-year mark, there's even more if you opt to take the 50% BRS option at the 20-year mark. But again, we'll get into that in a separate topic. So let's start talking about Retire Max Elite. Okay, what is Retire Max Elite? Well, this is a system that I personally created. Okay, and what we did is we fused together multiple strategies within the realm of capabilities in the industry that I work in, okay, as a financial professional. And we basically came up with a system that's tailored to veteran needs. Okay, it's tailored to the military service member, the veteran, even the federal employee. Why? Because this is a background that I share. Okay, I understand. I've walked in your boots, and I understand some of the nuances, the financial nuances of the military community, which differ significantly from the general public. Okay, and we created this system. We fused together these strategies to be able to optimize it for our military brethren, our brothers and sisters in uniform. And we even published a book about it, okay? The book itself, same thing. Retire Max Elite, the Veteran's Guide to Tax-Free Wealth and Financial Freedom. It's available on Amazon, but if you guys send me a DM here tonight, I'll send you a free copy. And you know what? I'll even pay for the shipping, okay? So I'll pay the shipping and handling. I will send copies of this book out. If you want, just go ahead and DM or comment wealth, and I'll send you a free copy of, again, Retire Max Elite. It's available on Amazon, okay? But tonight, we're going to talk about it from the angle of building a pension, even if you didn't serve 20 years. All right. So, we want to prioritize zero market risk. We don't want our money at risk in the markets. We don't want to have to worry about losing money because, as Warren Buffett said, right, the number one rule of investing is don't lose money. And incidentally, rule number 2 was C rule number 1, okay? Losing money has a larger impact on your financial plan for being able to draw in a sequence of returns, okay? It has more of an impact than actual gains do, okay? So if you can imagine, losing 40% has a larger impact on what you earn year to year in terms of your returns, okay? Now, we also want tax-free income. Why do we want tax-free income? Because who in the hell wants to pay more in taxes, right? Nobody does. Well, maybe there are some people that do, but nobody that I know wants to pay more in taxes. If you want to pay more in taxes, hey, just go ahead and comment taxes down below. But no, seriously, if you don't want to pay more in taxes, say no more taxes. There you go. You can comment no more taxes, right? We want to try and minimize taxes, and we have strategies where we can convert savings into tax-free income as well. Tonight, we're going to focus on just building out a pension basically from scratch. Okay. And then our third priority is creating a family legacy. Okay. I believe that every veteran deserves to be a millionaire. Okay. I do. Right. I believe that your service to this country, that your sacrifices have merited the highest financial rewards that this country could offer. And so what we want to do is we want to create lasting legacies so that your grandchildren, your great, 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 great grandchildren know who you were and what you did for this great nation, for the United States of America, right? And we do that through creating legacies, right? And we also do that through protecting legacies. So, we also want to create income protections and, shields against catastrophes that can happen along the way. So we use these type of strategies to do that as well. All right. So tonight we're going to focus primarily on a case study involving a 25-year-old. Now, I understand that for most of us out there, myself included, saw 25, we won't say how many years ago, but it's been a few. Okay. That's okay. These strategies can still be adapted at any stage. And in fact, we just did a webinar not too long ago where we focused on different strategies at different stages of life. But tonight, we're just going to kind of set the baseline. Okay, the baseline is that we're going to start with somebody who's coming into the military brand new. Let's say they're 25 years old, maybe they're fresh out of college, and they're coming into the military, they're starting their career, and they want to basically be able to build their retirement. But here's the catch. Here's the little catch. They're not going to serve 20 years, right? So they're only going to serve 10 years, and they still want to be able to build a pension. So we're going to show how we can do it, okay? So we're going to say joins the military at E3, okay, as many do, maybe, fair enough, right? So joins the military at E3 at age 25. Focuses on both, obviously building a career, but also on financial planning. And we're going to say that this service member gets promoted to E6 by year 10, right? So he's going to make E4 roughly about 2 years in, maybe E5, 3 years from that, maybe E6, he's on a good run. He's going to make E6 by, roughly about that 7 or 8 year mark. And go ahead and separate from the military at the 10-year mark as an E6, okay? Now, we're going to start from day one building this private pension strategy, with approximately 10% of his pay. Now, this could be give or take. Our numbers are, when it comes to the 10% is obviously not going to be exact because we are trying to factor in allowances, which are going to change based on locality, et cetera, but we're going to roughly target about 10%, which is about what he would be contributing to TSP if he were getting the 5% match and putting in 5% of his income. But in this case, we're only going to, we're just going to go with the 1% automatic enrollment of TSP under the BRS system. And we're going to take 10% of the remaining income and we're going to put it into our RetireMax Elite private pension strategies. Okay. And what we're going to do in this case, we're going to use a properly structured indexed universal life contract. Okay. Properly structured, I want you guys to remember that. Properly structured is key because the way that we structure these policies is critical to how we build cash value in the policy and how we sustain the death benefit, okay? The death benefit is not the primary focus of a private pension IUL, okay? The cash value, the living benefits are the focus of it, not the death benefit. The death benefit's just kind of along for the ride. And remember, our service member already has $500,000 of SGLI while he's in. So I'm not worried about, having some major death benefit to cover him for, catastrophes. He already has what he needs to be able to cover in case of premature death. What we are focusing on is building tax-free cash under IRS Code 7702. All right. So let's talk about our funding plan. So again, we're focusing on 10% of the income. By the way, we have a video on YouTube where we talk about how a service member could build a $3.5 million pension retirement plan using just 10% of their income over the course of 20 years. So if you guys are watching on YouTube, after we finish up here, go ahead and check out those other videos. You'll see the video on there. It's basically the 10% to 3.5 million is what we're talking about. Okay, so let's dive in here. So years 1 through 3, we're going to use a step-up funding plan, right? So we're going to start low and we're going to gradually increase our contributions essentially as he continues to make rank, make more money, etc. Okay, so the funding plan is going to start years 1 through 3. We're going to put in $300 a month. Okay, he's not making that much as an E3. Okay, we just, we got to acknowledge that. So he's going to put in $300 a month into the IUL, starting in basically at the beginning of his career. Okay, now at year 4, he's going to step that up. Okay, so at year 4, he's going to increase it to $500 a month going into the policy. Okay, and then at year 6, he's going to increase it again up to $900 a month, and he's basically going to leave it there. Okay, now we're only going to fund this pension for 20 years. Remember, he's only serving for 10. We're going to fund it for 20 because, we're assuming that when he gets out of the Navy or the Army or whatever, right? When he gets out, he's probably still going to work, right? He's not just going to hang up the gone fishing sign after 10 years. He's going to use that as sort of a step ladder into his next career. So he's still going to be earning money, right? But we're going to be conservative here, and we're going to say, yeah, we want to fund this entire pension plan in 20 years, okay? So from years 7 through 20, he's going to be putting $900 a month into his private pension plan. Now, before we move on, I want to mention, and I want to underscore the fact that his money is still available to him the entire time that he's building it, okay? Now, that is another benefit that you don't get with TSP. You do not have that kind of liquidity with TSP. There are very, very few instances in which you can borrow against your TSP or even tap into it. It has to be a financial hardship, okay, while you're still serving or while you're under the age of 59 and a half even, to be able to access those funds penalty free. Even if you're out of the military, if you want to touch your TSP funds before age 59 and a half, it's going to come with a tax penalty, okay? And you're also going to pay tax on every single dollar that you earn in the TSP because most of it is tax deferred, okay? But in this case, he has full access to the funds the entire time that they're growing, and he can use them for whatever he wants. Very simple process to access them, by the way. All right, so let's go back to the 1% contribution. So in this case, because our service member at age 25, when he joins, he's automatically enrolled in the 1% contribution program from the government to his TSP, okay? And he also has up to a 5% match if he chooses to use it. Personally, I wouldn't, okay? But let's just say he sticks with the 1%. So if we assume roughly a 7% market return, and again, this is assuming that the markets cooperate, right, and we don't see a major collapse, generally the money is going to go into a very conservative profile anyway. Most of it's even going to be in the G and the C funds, okay? But if we assume that the markets cooperate and he earns an average of 7% return, then at the end of his 10-year period, he's going to have about $7,000 of government contributed funds in his TSP. And he's going to have full vesting in that, right? Meaning that money's his. He can do whatever he wants with it. Okay, so that's just it's a retention tool. The government's going to contribute that. He doesn't have to serve 20 years to be able to get access to that. Now, when he gets out, he's going to basically conduct a strategic rollout. Now, I don't like the term rollover. That's what we kind of got on the slide here, but he's going to do what's called a strategic rollout, meaning he's going to get that money out of TSP. He's just going to withdraw. Okay. Now, yes, is that going to result in a 20% withholding plus potentially the 10% on the back end? Yes, of course it is. He's still going to have to pay tax on it because he hasn't paid tax on those funds yet, right? So he's still going to have to pay tax and it's still going to record as earned income. But here's the thing, right? He's only going to pay that one time. And he's paying it on the seed as opposed to paying it on the harvest, right? Which means that he's going to pay a hell of a lot less in tax, by just simply withdrawing the $7,000 and taking what's left over. We'll call it roughly $5,600 that's left over after he's done with the 20% withholding, which is probably going to cover his 10%, by the way, at the end of the year. So he's going to basically have access to that money. It's going to be pure cash at the end of his tour, and he's just going to be able to dump that into his private pension fund and let it grow tax-free from there on out and convert into tax-free income later on. All right, now we're going to add one more layer to this, and we'll kind of show a breakdown of an illustration here in just a few minutes, but let's kind of highlight this first. He's going to incorporate strategies that we call dynamic banking. Some people call it becoming your own bank. Okay. And basically by doing this, he's going to accelerate the growth on his private pension plan while also being able to acquire additional assets using his liquid funds. Okay. So again, this is something that TSP simply cannot do. You cannot fund your own cars with your TSP. I'm sorry, you can't. Not before the age of 59 and a half or while you're still in the military, or even, after you retire from the military and you still have funds in TSP, you cannot take car loans from your TSP. It's just not possible. Okay. So this is a plan that's going to allow us to do that. That's basically going to allow us to reposition interest money that the bank would have otherwise been siphoning out of our budget. Okay. We're going to be able to reposition and recapture every dollar that we pay for these cars going forward for basically the rest of our lives. Okay. But in this case, we're going to talk, we're showing basically doing that up until he starts drawing income at either 60 or 62. Okay. So we're going to be buying cars. We're going to be funding our own cars out of this policy. Okay. And it's very possible. And I'm going to show you how we can do that. Right. So we're going to take a $30,000 car loan at year 10. Okay. And then we're basically going to repay ourselves. He's going to repay himself over the course of 6 years at a normal interest rate that you would expect to see in the auto industry. Okay. And then when he pays that car off at 6 years and he has a paid for car, he's going to do it again. And then he's going to do it again. And then he's going to do it again. Okay. And we're just going to keep doing that because we're adding in that dynamic banking. We're adding that interest from your dynamic bank into your policy to be able to grow your cash values. Okay. And again, we're growing it 100% tax free. All right. And then at year 11, what's he going to do? He's going to take out that $7,000 minus taxes. So roughly about $5,600. It's going to go into the policy at year 11. He's going to continue his $900 a month, right? We said he's going to fund it from years 7 through 20. So he's still going to be putting $900 a month into the policy. And he's just going to take that $500 a month car payment that would have otherwise been going to the bank, otherwise been going to help rich bankers buy new yachts for their birthdays, right? Just like what we talk about. And he's going to put that money back into his own pension fund, his own private pension fund. Okay. And we're going to earn money the same way that the banks are. Now, he's not limited to this, but this is what we're going to focus on just for tonight's scenario. He could be doing a lot more than just funding cars out of this policy. I promise you. But tonight we're just going to say, hey, all he's going to do is just fund the cars out of the policy. And we're going to see where this goes. Okay. Now, by year 20, what does he have? Well, let's go ahead and instead of showing this slide right now, let's go ahead and just take a look at our ledger. We're going to remove this from the stage for a second, and we're going to put up our actual non-guaranteed scenario. So this is our illustration. Okay. So we said the first 3 years, he's going to put in $3,600 a year, $300 a month times 12, $3,600. Okay. He's going to start off with a $350,000 death benefit. Now, do we need to start with $350,000? No, we don't. But we want to make sure that we give ourselves enough room to where he's going to be able to grow these cash values year after year after year. So we're going to set this as an increasing death benefit, and we're going to start at $350,000. Now, if you're doing math, right? If the math is mathing, that SGLI is $500,000. So how much death benefit does he have for those 10 years that he's in the military? At least $850,000. And by the time he's out of the military at year 10, he's got about $900,000 of death benefit. Okay. So that being said, he's going to $500 a month going in years 4 through 6. I'm sorry. And then 7 through 20, he's putting in the $900 a month. Now, what do we see here? At year 11, he's going to put in that $5,600 that came from the TSP after tax, right? Then he's also going to start doing his car payments, right? Because we took the $30,000 car loan at year 10. So now he's going to start repaying the car loan, for 6 years at roughly about a 5 or 6% interest rate. I think we calculated 6% in this case. Okay. And then he's still got the $900 a month. Okay. So the $900 was what he wanted to save into his private pension plan. So he's adding that on top of it. Okay. And we get all the way down here to year 20. And we can see that at year 20, we stopped putting in the $900 a month. Okay, now what funds are still going in? The car payments, right? Because he's still taking car loans, right? He took a car loan at year 16, took a car loan at year 22, and he took another one at year 28. So all we're doing after year 20 is we're just repaying the car payments, okay? The same way we would be paying to a bank if we were borrowing from a lender, right? So we're just repaying it to ourselves, okay? So even by year 20, in this case, he still has over $302,000 of cash value available. So again, we said, if he wants to fund more than just his cars, he's got $300,000 of cash value as he's leaving the military at the 10-year mark. Okay. And he's also got a $780,000 death benefit that's continuing to build year after year. Okay. Now we get all the way down to age 60. All right. So we stopped funding the policy. Right. So we stopped funding the policy at age 60. And now we've put in basically $329,000. So let me go back and I'm going to remove this from the screen for a second, and we're going to go back to the slide. So we funded it for 20 years, and we basically had $180,000 of our own income went into the policy, right? Because we don't really want to consider the car loans to be our own contributions. The car loans that money would have otherwise just been going out the window of the bank. So we're going to look at this in terms of $180,000 of his own money went into this policy, with $7,000 after tax, about $5,600 from the government's money going into this policy. And then he put in the car loans. And what does he get in exchange for that? Well, at age 60, he's going to have about $1.2 million of accumulation value. Okay, so let's go ahead and go back to our ledger here, right? So at age 60, he's got about $1.2 million of accumulation value, and he has about $969,000 of cash value still available. Why not the same? Well, because we still have those car loans in the policy that are still kind of hanging out in the background. We put this in the form of premium, but we still have about $969,000, almost $1 million of cash value available. This number really is the more important one, though. Why? Because this accumulation value is what his income is going to be based off of in the future. Now, it also is worth noting that he also has about a $1.4 million death benefit at age 60 that's been growing the entire time, right? So God forbid, if something were to happen to him at any point along the way, his family is still going to get, potentially over $1 million, right? By the time he hits age 50, right? But in this case, he's got almost $1 million of cash value available with $1.2 million of accumulation. And if he wants to start taking income this year, okay, if he wants to start at age 60, taking that income, he could take $91,000 a year tax-free for the rest of his life. $91,000 tax-free for the rest of his life. But it gets even better, right? Because his accumulation values, regardless of what he's withdrawing every year, because he's not actually withdrawing the funds, he's taking them in the form of policy loans against the death benefit, which is the smart way to take this money from a policy like this. If he simply defers income for 2 years, right? Simply 2 years, it's up over six figures. $105,000 tax-free every single year, okay, for the rest of his life. And he still gets a death benefit. He could even take more than that if he wants to, right? It may not last as long, but if he lives to age 85, okay, we do a comparison here, right? So again, he's put in $180,000. right? The government put in 5,600. He bought 4 cars out of this policy, right? Every one of those cars has value as well, right? So his lifetime return, if he was to start income at age 62 and he lived to, let's say, be 85 years old, that's $2.5 million of tax-free retirement income, and he still has an $835,000 death benefit at the end of it. So when you add those numbers together, $2.5 million of income, tax-free income, you add that to his tax-free death benefit, and you get $3.3 million of total tax-free benefit off of $180,000 of total lifetime contribution. That is a massive, massive win. Okay, that is a huge, huge return on your investment. $180,000, and what did we start out with? $300 a month. $300 a month. For 3 years, he increased it. We basically did 10% of his income, right? Went into the policy. Starting in the first year, he stopped funding it at the 20-year mark. The rest of it was pure compounding interest plus the power of dynamic banking. And he generated over $3 million of tax-free income as a result of it. And over $800,000 of that, assuming that he spends every single dime of that $2.5 million, which, I mean, is he really going to spend that much? I don't know. I mean, he doesn't have to. Do you spend every single dime of your annual salary? You know, probably not, right? We put some back, we give some away, we, whatever. But even if he spent every single dime of that $2.5 million, his family's still getting over $800,000 when he passes away. And from there, the plan is that we want to create a waterfall strategy so his kids and his grandkids get set up with the same kind of policies that he has, so that that money will then go into their compounding accounts and be able to generate millions of dollars the same way that it did for him. Okay. So again, $180,000 total, starting at $300 a month, turned into over $3 million of tax-free benefit in the end. Okay, so just a real quick head-to-head comparison. Okay, we said that TSP under high 3 redux and BRS is still exposed to losses. Okay, you can still lose money in the TSP. Many people did, especially in 2022, especially in 2008. People that had money in privatized IUL plans like what we have in Retire Max Elite lost zero. Okay, they lost zero. Their money was 100% protected against any volatility in the market. Okay, income taxation in the TSP, every single dollar is going to be taxed. Okay, because we're putting money in tax deferred. Therefore, we're going to pay money on the harvest later on when that money blossoms. And even with the match, okay, people love to talk about the match, right? And they say, oh, well, I'm getting free money with the match. If I put in 5%, the government's going to give me 5%. That's free money. And to which I say, yeah, but is Uncle Sam paying his own tax bill? He's not, right? That money's going into your account. It's growing. Yeah, you're vested in it. It's growing in your account. But guess what? You are on the hook for the taxes. You are on the hook for the taxes on every single dollar of capital gains and every single dollar that you take of earned income. You're going to pay somewhere between 25 and 30% of that in retirement, okay? And of course, the money is going to be at risk the entire time in the market while it's growing, okay? And you also don't have liquid access, right? You get limited, very, very limited scenarios where you could leverage the money in your TSP account before age 59 and a half, essentially age 60, without significant penalties, okay? You can't just borrow a $30,000 car loan from TSP under normal circumstances. It generally doesn't work. And if you do, you can only do it one time, okay? And that loan, there are very strict provisions under which that loan has to be repaid, right? In this scenario, you own the terms of the loan. You don't necessarily have to repay it. It behooves you to, but you basically control those terms, not the government at that point. So you maintain that control in privatized plans like what we offer with the Retire Max Elite. Okay, car financing, essentially with TSP, you got no benefit, okay? With Retire Max Elite, you can become your own bank, you could fund your own cars, you could fund your own vacations, your own weddings, You could fund whatever you want. There are no stipulations on how you use the money. There are also no stipulations on how you set up your beneficiaries later on. And that'll be another topic for another week's discussion, where we talk about beneficiary benefits of privatized plans versus using the ones that the government provides. Okay. And then, of course, when it comes to legacy planning, you've also got the inheritance. Okay. Now, obviously, there's only a handful of states that impose an inheritance tax. And from the federal standpoint, it's at a very high level right now. Right now it is. Okay. But even still, right, even if you have, let's say you got $1 million in the TSP and that were to confer to your family, well, that's going to record as $1 million of earned income. Right. And there are some stipulations in which they can roll those funds over into non-qualified accounts, but then they're also subject to required minimum distributions. And those funds have to be liquidated because at the end of the day, Uncle Sam doesn't like tax deferral for that long. Okay. They use it as an incentive primarily for business owners. Okay. The 401k construct was primarily designed to incentivize business owners. But Uncle Sam has a pretty insatiable appetite when it comes to those tax deferrals. And he's not going to let you defer those taxes forever. At some point, even if it's by age 73 under RMDs, you're going to have to start taking those distributions because the tax man cometh, right? But in this strategy here, in Retire Max Elite, we don't like taxes. We want to build tax-free income. So we're going to pay as little as we possibly can. And for those who have savings in TSP, we're going to take additional steps later on to be able to convert those funds into tax-free income too. And we'll talk more about that in future videos. All right, so key takeaways, the BRS reality check, right? So in 2018, we shifted to the current BRS system, which is now in effect for every service member that comes into the military today and for the foreseeable future will be automatically enrolled under BRS. The days of high 3 redux are coming to an end, okay? With the Retire Max Elite program, again, this is a veteran-focused program. It's designed specifically for veterans, their families, and other patriotic Americans, right? First responders included, right? But it's designed for veterans to maximize your benefits and be able to build privatized retirement strategies that are going to make you rich, okay? They're going to make you wealthy. And they're going to take that control out of the government's hands and put it back into your hands in your family's control, okay? And again, this is a strategy that works whether you serve 20 years or whether you serve 10 years or even 5 years, okay? We want to be able to build a high quality retirement, a comfortable retirement, no matter how long you serve, no matter how many years. We believe, I personally believe, that as a veteran of this nation, you deserve to have a comfortable retirement, and that's what we're building here. All right, so that's about all I got for tonight. So we finished up a little bit early. Awesome. We normally block off the entire hour, but what I'll do is I'll go ahead and hang back for a few minutes. I'll probably turn the camera off and we'll kind of cut here, but I will hang back in the social media channels. So whether you're watching on YouTube or Facebook, whether it's on my personal profile or whether it's on the Victory X Financial Facebook page, I will hang on for just a few minutes after we conclude here. So if you guys have any questions, feel free to put them in the chat. Again, just as a reminder, if you guys comment wealth here tonight, you're going to get a free copy of our Retire Max Elite book. This is available on Amazon. It's the Veteran's Guide to Tax-Free Wealth and Financial Freedom. We also have an online, it's sort of a condensed version, but it's an online free training guide for military members and their families that talks about, just kind of gives some of the highlights of these strategies. So if you click on the QR code that we just put on the screen, just right up here, okay, you click on that QR code, it's gonna take you to a landing page, and that's going to allow you to download our free online training guide where we talk more in depth about these type of strategies, and we kind of introduce, a lot of the individual concepts and how we work with savings accounts or larger savings sums, how we can build private pensions, how we can, do this to build tax-free income later on, and ultimately how we protect families, protect homes, and create legacies of wealth for our veterans. So again, click the QR code if you guys want to get our free online, guide here tonight. Comment Wealth if you want a free copy of our Retire Max Elite book. I'll send you one. Again, Comment Wealth. You get a free copy of our Retire Max Elite book that's available on Amazon. Want to thank everyone for joining us here this week. Again, this is going to be a weekly series, so mark your calendars for next week at 5 o'clock. I know we started a little late this week, but 5 o'clock next week, we're going to be back on, and we're going to be talking about various and sundry topics related to our Retire Max Elite strategies and how we help veterans build lasting legacies of wealth. So if you guys have any questions, feel free to drop them again in the comments. We'll make sure we get them answered. I'll hang back for a few. And otherwise, we will see you guys next week. Have a good one.
It's your thing. Do what you want to do. I can't tell you. Wish I could do it. It's your turn. Do what you want to do. I can't tell you. Wish I could do it. You want me to love you. Maybe.